Did you know that covered calls can help you try to limit your losses in options trading? Well, if that's news to you, then you're in luck because this class we'll be talking all about covered calls. I'm Adam Matt, Director of Education at Pennybois University, and welcome to class number 14 of Pennybois University LITE. This is class 4 in a 10-class series in options trading, part of PBU LITE, which is 100% free. Make sure to check the description in this video for the handout as well as a class video game. One way to use options is to write covered calls to try to limit your losses. A covered call is a strategy where I own 100 shares of a stock and decide to write, meaning sell, like we talked about last class, a call option on the same stock. So I'm selling the option to buy a stock at a certain price by a certain date for a stock I actually already own. So I receive the premium for selling the call option. If the stock price stays below the strike price of the call option, the option will expire worthless, and I will keep the premium as profit. So in theory, if the stock goes down and I decide to sell my 100 shares of stock for a loss, the money I made from the call's premium expiring worthless will help offset that loss. So for example, let's say that you buy 100 shares of stock XYZ at $30 per share, so that's $3,000 you spent for that 100 shares. You don't believe that the stock is going to go up higher than $35 per share within the next month, so you decide to write or sell a call option with a strike price of $35 and an expiration date of 1 month from now. You receive the premium for selling the call option. Let's say the premium is $1 per share, so you get $100 for writing the call option. If the stock price stays below $35 at the expiration of the option will expire worthless, and you will keep the premium of $100 as profit. So the stock goes down to $29 by the end of the month. Your 100 shares that you bought for $30 each at a total of $3,000 are now worth $29 per share at a total of $2,900. So you are now at a $100 loss on your shares. However, since the option contract you wrote or sold with a $35 strike price expired worthless, you keep the $100 premium, so it balances out your potential loss. So when writing a covered call, it is important to know the difference between at the money, ATM, in the money, ITM, and out of the money, OTM. If the strike price is set the same as the current stock price, the option is considered to be at the money for both calls and puts. For calls, in the money are contracts that are lower than the strike price, and out of the money are contracts that are higher than the strike price. For puts, it's the opposite. So basically, in the money means it wouldn't expire worthless if the stock price stayed the same. So basically, in the money means that the option would not expire worthless if the stock price stayed the same as it currently is by the end of expiration. And out of the money means that it would expire worthless if the stock price were to stay the same by the time that expiration happens. So for contracts that are in the money, the premium received for writing the option will typically be higher compared to writing an out of the money option. However, the farther in the money you go, the more likely it will be exercised. So what happens if your covered call is exercised? Well, if the stock price goes above the strike price, so in our example earlier where I bought 100 shares of a stock at $30 and wrote an options call with a strike price of $35 with an expiration a month away, if that month goes by and the stock price goes above $35, let's say to $40, the option buyer may exercise the option that I wrote, forcing me to sell my 100 shares at the strike price of $35, even though the stock is currently trading at $40. So instead of selling 100 shares at $40 per share for a profit of $10 per share or $1,000, I'm instead selling my 100 shares at $35 per share per the options call contract for a profit of $5 per share, so $500 profit. Plus I still keep that premium of $100, so that's a $600 total profit, but I missed out on $400. So covered calls can limit your losses by letting you keep the premium. However, it can also limit your profits by making you exercise the contract. The covered call is a low risk strategy as the investor already owns the stock, reducing exposure to the market fluctuations. However, like most things in trading, it has to be done properly to truly work out, and is not recommended to brand new options traders, but it's a good tool to be aware of. Spread trading is another popular strategy used by options traders to make money by taking advantage of the difference in price between two options contracts. Make sure to tune into class number 15 where we talk all about spread trading. We also have a complete options 101 class in our free trading Discord, as well as an advanced options strategies 102 class in the premium area of the Discord, as well as educational options, trading live streams with Q&A with veteran traders. I hope to see you all there, but until then, I hope that you all make some bread.